So, the stock market just did something, well, pretty confusing. On the surface, some of the big indexes hit all-time highs. But at the exact same time, the entire tech sector took a nosedive. How does that even happen? Well, it's not really a contradiction. It's actually a story about a major shift happening right under our noses, and we're going to break it all down.
And this is the central puzzle right here. On one hand, you've got the Dow and the S&P 500, these really broad measures of the US economy, just soaring to new records. But on the other hand, the tech-heavy NASDAQ is stumbling, getting dragged down by some of its biggest, most popular names. So, how can both of these things be true at once?
This wasn't just some random chaotic day of trading. What we're seeing is really a tale of two different markets, heading in completely opposite directions. People are starting to call it the Great Divergence, and it's a huge split in how investors are thinking about the future of the economy. And you can see this split crystal clear when you just look at the weekly numbers. The Dow, it had a solid 1.6% gain. The S&P 500 was up 0.5%, but the NASDAQ barely moved. It was basically flat. That massive gap in performance is the key to understanding what's really going on here.
Now, what makes this whole thing even weirder is that it happened right after the Federal Reserve cut interest rates. I mean, lower rates are usually like rocket fuel for the stock market, especially for those high-growth tech stocks. A Fed cut should have lifted all boats, but it didn't, which really begs the question, why did tech sink?
And that brings us right to the heart of the issue. This divergence isn't just about the numbers on a screen. It's about a fundamental shift in thinking. We're in the middle of what you could call a great tech reassessment, where investors are suddenly taking a much harder look at the very sector that's been dominating for years, particularly the darlings of the AI boom.
The trigger really came from a couple of key tech players. First, Oracle came out with some disappointing cloud numbers. Then, chipmaker Broadcom gave guidance that basically poured gasoline on what people are calling AI bubble angst. So even though their current numbers were pretty good, their outlook for the future made people really nervous.
And the market's reaction? It was brutal. I mean, look at this. Despite beating its earnings estimates, Broadcom's stock just plummeted 11%. This wasn't a punishment for bad results. It was fear that the future might not be as incredibly profitable as everyone had been hoping. The market was sending a clear signal. Good just isn't good enough anymore.
So what's the psychology here? Well, it's a textbook case of buy the rumor, sell the news. For months, investors have been bidding up these AI stocks like crazy in anticipation of huge growth. That's the rumor. But when the actual news came out, even though it was positive, it just couldn't live up to the sky-high, almost impossible expectations. So the traders who got in early, they decided it was time to cash in and lock in those profits, and that's what leads to the sell-off.
So if all that money is flowing out of tech, where's it going? We're seeing a classic rotation. The money is moving into more traditional, value-focused parts of the market. We're talking industrials, financials like Visa, even healthcare giants like Eli Lilly. These are the new winners, at least for now. And the losers? The very AI chip makers and software firms that have been leading the pack for so long. It really is a changing of the guard.
Okay, so I know this might sound a little alarming, but there's a very positive way to look at all of this. The bull case, the optimistic view, argues that this isn't a sign of a sick market at all. It's actually a sign of a healthy one. This isn't a crash, it's just a rotation. Right, so the bullish argument goes like this. Money is finally spreading out beyond just a handful of big tech names. It's flowing into a wider range of industries, which creates more balanced and sustainable growth for everybody. Plus, that Fed rate cut is still a huge positive for the whole economy. And maybe most importantly, we're not seeing that crazy, irrational excitement that you usually see right before a big crash. This just looks like a classic healthy rotation. Of course, there's always another side to the story. The bear case argues that this weakness in tech isn't some healthy rotation. No, it's a warning sign. It's the canary in the coal mine for the entire market.
The bearish argument points to some pretty big red flags. The VIX, which is basically the market's fear gauge, jumped 15% in a single day. That's a clear sign of anxiety. You've got professional traders buying up protection against a downturn, and underneath it all are these nagging concerns that, yeah, maybe AI stock prices got way ahead of themselves and that persistent inflation could still come back and wreck the party.
And you can really see this split personality when you look at how investors are feeling. On one side, surveys of individual, everyday investors show they're getting more optimistic. But on the other, the professional indicators, like the VIX, they're flashing caution. It's a classic tug-of-war. Main Street's confidence versus Wall Street's nervousness.
So with these two completely different stories playing out, how do we know who's right?
Well, the key is to watch the signposts. The market is actually giving us some really clear signals that will help tell us which way things are heading.
Here's your checklist. First, listen very closely to what the Federal Reserve says next. Any change in their tone about interest rates or inflation is going to be huge. Second, the next round of corporate earnings, especially from big tech, is going to be absolutely critical. And finally, keep a close eye on those big economic reports, the inflation numbers and the jobs report. Those three things will very likely decide the market's next big move.
So, as we pull all these different threads together, the picture that emerges is pretty clear. It's a market in the middle of a major transition. It's moving from one phase to another, and that's what's creating all the turbulence and mixed signals we're seeing right now.
And look, if you take away just one thing today, let it be this. This isn't just random chaos. It's a rebalancing. For years and years, the market has rewarded pure growth potential, sometimes at any cost. Now, that focus is shifting to something much more tangible: current profitability and real, measurable value.
And that leaves us with the ultimate question, doesn't it? Are we witnessing the beginning of the end for tech's decade-long dominance, or is this just a temporary detour before the next big rally? The signposts we just talked about, they're going to tell the story. Thanks for watching.